Hello, students, teachers, parents, history nerds. Hello, everybody, and welcome to Nutshelled History, where we lay out the facts, the good, the bad, and the ugly. Today, we are going to continue our economics series by looking at money, banking, and financial markets. Don't forget that there's a link for a fill-in-the-blank worksheet in the description. I just ask that you like and subscribe. I apologize for any mispronunciations ahead of time. I do my best. All right, let's roll. Money, in a nutshell, is the superstar of the economy. It's anything that lets you swap stuff, count how much stuff is worth, and keep that worth stored for later. Think of it like the ultimate trading card. It's durable, portable, divisible, like slicing a pizza, uniform, no funky shapes, please, scarce, like a limited edition collectible, and accepted everywhere. You can't just hand someone a shiny rock and expect them to give you a sandwich. Well, maybe you could, but that's called commodity money. And we've moved on from rocks to paper and coins, known as currency. And now, we just trust the government says it's worth something, fiat money. Banks, starting in the 1790s, were set up to help keep track of all this money moving around. But just like any good reality show, not everyone agreed. People thought these early banks only helped the rich. Cue drama. The first banks didn't last long, probably because they didn't have a good season finale. Then came the free banking era, which was less free and more chaotic. Banks printed their own money, backed by gold and silver, or at least they were supposed to be. Spoiler alert, many weren't. Cue the Civil War and bank reforms. Suddenly, we got national currency and stricter rules. Fast forward to 1913, and the Federal Reserve System, the Fed, is born. Think of it as the responsible adult of banks, making sure the whole financial house doesn't burn down. It lends to other banks in need and keeps a close eye on money matters. It's also a master multitasker, running the Treasury's checkbook, issuing currency, and making sure your Social Security checks go through. But of course, not everything was smooth sailing. Remember the Great Depression? Banks crumbled and people's savings went poof. In came the FDIC, ensuring your money's safe even if your bank takes a nosedive. Skip ahead to 2008. Banks made risky bets on homes, thinking they'd cash in big. They didn't. People couldn't pay their mortgages, and a financial crisis hit harder than a plot twist in a soap opera. Banks stopped lending, people lost jobs, and it all went downhill. Nowadays, banks do more than just store your cash. They help you buy a house, invest, and even let you manage your money from your phone. Investing is like planting money trees, except it takes a lot longer and doesn't involve magic beans. The basic idea is to not spend all your cash on pizza today so you can have even more pizza in the future, thanks to economic growth. Investors, aka savers, lend their money to borrowers, governments and businesses who use it to build stuff like roads, factories, or the next must-have gadget. Now, it's not just random people handing out loans. There are matchmakers in the financial world called intermediaries. Think banks, mutual funds, and hedge funds. Hedge funds are like the adrenaline junkies of the investment world, chasing big rewards, but also risking some serious wipeouts. To keep things balanced, savvy investors use a strategy called diversification, which is basically the adult version of don't put all your eggs in one basket. By spreading out their investments, they minimize risk. However, just like in life, you can't have everything. Safe savings accounts may keep your cash cozy, but they won't bring you the high returns that riskier investments might. Bonds, for example, are like the grandparents of the investment world. Steady, reliable, and low risk. But don't expect them to throw a wild party, aka high returns. Governments, cities, and corporations love issuing bonds because they get to borrow money now and pay it back later without stressing over changing interest rates. It's the set it and forget it of the financial world. Stocks, on the other hand, are like that roller coaster you're not sure you should ride. Sure, you might win big if you sell your shares for more than you bought them. Hello, capital gains. But if the stock market does a nosedive, you could end up with less than you started. And yes, stock markets even come with mascots, the bull and bear markets. The bull market is when stocks are on the rise and everyone's throwing confetti. The bear market is when things take a downward turn and it feels like hibernation might not be a bad idea. Over time, markets have had their ups and downs. like the Roaring Twenties that ended with the infamous Great Crash of 1929. More recently, the 1990s gave us another bull market, but that too came crashing down in the 2000s. The moral of the story? Whether it's bonds, stocks, or savings accounts, every investment comes with its own brand of drama. Choose your financial adventure wisely. And now, a quick recap. Money is like the economy's all-star trading card. It helps us swap, count, and store value, whether it's in coins, bills, or digits on a screen. Banks popped up in the 1790s to keep track of all this, but not without drama. Things got wild in the free banking era when banks printed their own money, often not backed by gold or silver, causing chaos. Fast forward to 1913, the Federal Reserve was created to be the grown-up in the room, keeping the financial system in check. But banking's had its soap opera moments, like the Great Depression and the 2008 financial crisis. Nowadays, banks do much more, like help with investments, where bonds are the safe grandparents of the investment world, and stocks are the unpredictable roller coasters. Through booms and busts, one thing's clear: money and markets always come with a little drama. There you have it, folks. That is money, banking, and financial markets nutshelled. Thanks for stopping by Nutshelled History. Don't forget to invest in me by smashing those like and subscribe buttons. Would you do stocks or bonds? Let us know in the comments down below. See y'all next time on Nutshelled History.